Hello everyone, it's Davide here and welcome back to Learning Finance. In today's video guys, I want to talk about JD.com. So I want to give an update on the stock, which if you follow my channel, you know that I own the stock. I bought it back in November when I first covered actually the company with this video over there. It was the 25th of November and the stock was basically over there around $83 per share, 84. Then in later videos actually the stock was in the low 80s, sometimes even $79 per share, and I was buying over there. So as of today the company is up more than 20% actually today, all-time high $103 per share. But in today's video I want to show you why, in my opinion, this is still extremely undervalued, and it has as of today a 75% upside potential. So I'm gonna show you that. The only thing I ask you is please leave me another like, it's very important and I thank you for it, and subscribe to the channel so you don't miss any new updates. Let's begin. Now, if you have never heard about JD.com, I'm gonna briefly explain you what it is. Basically, it's the real Amazon of China, right? Because a lot of people usually say that Alibaba is the Amazon of China, while in terms of business model itself, the real Amazon of China is JD.com. And why? Because they do the fulfillment process, while Alibaba Stock can be compared more to an eBay business model. When it comes to JD.com, it's very similar to Amazon. So they have these huge logistics and facilities where they actually take the items and they do the fulfillment and the delivery, right? While Alibaba, you have that the merchants are actually doing the delivery and the fulfillment. So in terms of margins, obviously Alibaba is way higher, so that JD.com can really be compared with Amazon with lower margins, but probably a higher moat, all right, in terms of e-commerce, because it's not easy to build those facilities in a very short amount of time. So that makes JD.com unique. Then they have the e-commerce, which is their core business, JD Logistics, which is basically everything related with the fulfillment process, facilities, a lot of infrastructure that they built during the years with around 800 warehouses, with a total of approximately 20 million square meters of infrastructure. So this is huge. Now I'm going to show you something that basically we have just had the news over there. JD.com is basically planning to do a spin-off of JD Logistics. So this business, this division of JD is gonna probably go public in the Hong Kong Stock Exchange. Obviously JD.com, so ticker symbol JD, will be the main holder. So we'll continue to have more than 50% in terms of ownership. Now, why is that important? This is from yesterday. This is very important because a spin-off is actually great for a company in terms of scalability and cost reductions, and it can make the division itself become way more efficient. JD has already done that with JD Health, which obviously continues to hold in a vast majority of ownership. But the thing is that when you do a spin-off, you basically have a subsidiary which is able to gather capital alone, okay, in the market, and they're gonna have their own CEOs and stuff. Now the thing is that the main holding, which is JD, it continues to have the right on obviously a large part of revenues and stuff. But when it comes to costs, we can say that the logistic will be able to acquire new capital without basically having an impact on the costs of JD.com stock. So the main plan is actually to remain focused mostly on the e-commerce, then to have these subsidiaries which are actually able to capture capital in order to reduce costs so that the business overall can scale. And basically when you have a subsidiary, it's even easier for that kind of division to develop in a more efficient way, because you're going to have a management which their only objective will be to be focused in that particular business. Another very important part about JD is the investment that they do in technology. JD is the first real business that has done deliveries with drones, and they have already done those things. Now there are articles that they are saying that by 2040 more than 30% of all the deliveries will be made by drones. And another very interesting stuff is that a lot of their warehouses are actually driven by robots. So you have huge warehouses and just 3 or 4 workers, okay, real persons. Everything else is automated with robot and artificial intelligence. So also in terms of technology, research and development, they do a lot of investments and they try to develop. And in my opinion, this is great for the long term of the company itself and for the quality of the infrastructure that they are building. Now, when it comes to the valuation, actually, this is from the previous video that I did. I updated a little bit with new data that we have today. Anyway, it remains basically the same. If you want to see how I did it, just go back to see the previous videos where I explain it in details. This is a discounted free cash flow up until basically 28. And I have put in 2020 expectations. Now we are going through earnings basically in just a couple of weeks. So it's something that we really want to pay attention to. Analysts are expecting around $110.5 billion in revenue this year, and this is crazy because the market cap is just 160 billion. Okay, so 1.4 in terms of price to sales ratio, so it's very cheap. Amazon as of now is trading 5 point something. Anyway, we cannot compare, they are not the same stuff, Amazon and JD, but it's just to give you an idea. And for 2021 they're expecting 137 billion. Now, an important thing that we have seen in the last years is that JD, while they were building that huge logistic infrastructure, they were not profitable. Okay, so net income margin, you see from 2015 they were negative until 2019, where they first became profitable in terms of net income. And we can see that 3 quarters from 2020 where basically they have done very well, especially in Q2, 8.18% in net income margin. So that's a sign of the business which is scaling finally. And then 4.34% in Q3. So when I try to estimate the new cash flows, I actually put over there the net income margin, and I have considered that it is going to continue to increase in the next 8-9 years. Obviously, I don't expect extreme margins. I told you that this is a business similar to Amazon, which is characterized by low margins. Anyway, from a 5% in 2020, which considering the average of those, it's achievable, then going on until a 7.50% in 2028. And obviously, you have free cash flow divided by net income, the ratio. So those are the free cash flows. For the growth rate, those are analysts' expectations, right? So for 2022 going on, I've considered a 22% growth until 2024, then going down to 16 until 2028. Put all of that in the discounted free cash flow. The requirements, 12% discount rate, perpetual growth, 3%. Basically, we have that today the fair price of the stock is $181 per share. The stock is now trading at around $103 per share. So as of today, it's still, in my opinion, 43.10% undervalued, with an upside potential to fair price of 75.75%. So it's extremely undervalued. It's, in my opinion, it's a great business. It will continue to grow. And even though it's, Alibaba competitors, you have basically Alibaba, Pinduoduo, and JD. Even though it looks like they are fighting each other, in my opinion, all of them can coexist. Why? Because the Chinese market is so huge. It will continue to grow in the next 10 years. And those 3 companies, they actually do 3 different stuff. So they're not actually competing exactly, but they are doing different stuff. For example, JD is where you buy quality items. Pinduoduo is more where you buy little stuff, okay, things that do not cost as much. And Pinduoduo is having a lot of success because it's actually able to sell very cheap items, no brands, and is able to reach that part of the population which is not rich, right? Is not, let's say, they don't have much money to spend in brand items. While JD.com, for example, if you want to buy an iPhone in China, it's very likely that you're gonna buy it from JD.com. While Alibaba, on the other side, they have the biggest chunk in the market, but overall, in my opinion, those three big e-commerce, they can coexist. So I don't think that competition is a problem. And I think that JD.com, even at $100, is still very undervalued. So if you have seen my previous videos, you know that I bought the stock with an average price of around $80 per share. Anyway, I'm still holding and I'm not planning to sell anything. I hope you find this video interesting, guys, and leave me a comment below. Tell me what do you think about JD.com. Subscribe to the channel, and as always, guys, have a wonderful day.